Welcome back to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, March 27th, and the vibe is energy shock, inflation anxiety, and a dollar that decided to do cardio.
I love when the market says, "Good morning," by throwing a chair through my budget. If oil is at $110, I'm personally switching to walking and resentment.
We're doing 3 stories, fast and useful. 1. Inflation risk is resurging. 2. Oil climbing toward $110. 3. A helium shortage that could hit chips and even medical equipment. And yes, there's an action plan for normal humans.
Action plan? Great. Because my current plan is refresh my banking app and whisper apologies to it.
Story 1. The New York Times reports, resurgent inflation is testing faith in the Fed's ability to tame it, with the war in the Middle East risking a fresh inflation impulse, mainly through energy and supply disruptions.
So inflation is back like a sequel nobody asked for. Inflation 2, now with extra war. Do we at least get a loyalty punch card?
Simple version. Inflation is the economy's everything costs more fever. The Fed's medicine is higher interest rates, which cool demand. But an energy shock is like someone turning the oven up while you're trying to cool the house with the AC.
And then the Fed is like, have you tried making mortgages even more spicy? Meanwhile, normal people are just trying to buy eggs without financing them.
Why it matters. If inflation expectations rise, companies feel permission to raise prices, workers demand higher wages, and you can get a stubborn loop. For your life, this affects credit card APRs, car loans, and whether cash in a low-yield account quietly shrinks.
Okay, but what do I do today, besides staring at my subscription list like it betrayed me personally?
2 practical moves. First, treat your emergency fund like sacred, high-yield cash, not 0.01% nostalgia. Second, if you're carrying variable rate debt, prioritize paying it down. Rate shocks hit hardest when inflation stays sticky.
Protect cash, kill bad debt. Got it. I will now emotionally unsubscribe from my variable rate anything.
Story 2. CNBC reports oil prices climbed to around $110 as tensions around the Strait of Hormuz kept supply fears elevated, even with messaging about allowing tankers through. Markets are pricing risk into energy.
Oil at $110 is basically an invisible tax. You don't see it on the receipt, but it's in your delivery fee, your groceries, your flights, your everything, even my emotional support latte.
Exactly. Simple version, oil is a core input, fuel for transport, feedstock for chemicals, and a benchmark for broader energy prices. When it spikes, companies either absorb it, profits fall, or pass it on. Your cost of living rises.
Hot take. People should hedge by buying an electric scooter or moving into the grocery store. One of those is more realistic.
Here's the investing angle for normal portfolios. Don't confuse oil is up with I should gamble on oil. If you're diversified, you may already have energy exposure via broad indexes. The more actionable hedge is reducing energy sensitivity in your budget, driving, heating, and travel planning.
I disagree. Just a little. When a shock is this obvious, people do nothing and then act surprised. A tiny defensive sleeve can be sane. Not oil futures in your pajamas, but like energy-heavy value, or even just not being underweight the sector.
Fair push. I'll reverse slightly. A modest rebalance can make sense if you're extremely concentrated in rate-sensitive growth and you have 0 real assets exposure. But rule number 1, position size. If your hedge can blow up your plan, it's not a hedge, it's a hobby.
Thank you. Normalize small and boring as a strategy. My personality hates it, but my retirement likes it.
Story 3. The New York Times flags an invisible bottleneck, helium. It says about a third of global supply is offline due to the war in Iran, and suppliers are scrambling to reassure critical AI chip makers about disruptions.
Wait, helium? The balloon gas? You're telling me my kid's birthday party and advanced computing are fighting for the same resource?
Pretty much. Simple version, helium is used in high-precision industrial processes, including parts of semiconductor manufacturing, And it's also crucial for cooling superconducting magnets in MRI machines. It's not easily replaced on short notice.
This is the most 2026 sentence ever. Geopolitics might delay your AI servers and your medical scans. Cool, cool, cool. So what's the money angle, besides panic?
Why it matters. It's a reminder that supply chains have single points of failure. If helium tightens, chip production costs can rise, delivery timelines can slip, and sectors tied to AI hardware can see volatility. For households, it's another channel where war becomes prices without warning.
So the lesson is the future is built on weird ingredients. And if you're investing, you don't just watch earnings. You watch bottlenecks. Like, is there enough helium for the cloud? That's absurd and also apparently real.
Quick recap. Inflation risk is rising with energy shocks. Oil near $110 pressures budgets and can keep rates higher. And helium is a niche constraint with outsized impact on chips and healthcare equipment. Your playbook? Protect emergency cash yield, pay down variable rate debt, and keep diversification boring on purpose.
And if you're feeling doomy, zoom out. You don't need to predict the next headline. You need a plan that survives headlines. Also, maybe don't buy 400 balloons right now.
If this helped, leave a comment with one money move you're making this week. Cutting a bill, rebalancing, or raising your cash yield. Subscribe for the next briefing. Same feed, same mission. Make finance make sense.
And if your plan is do nothing, at least do nothing intentionally, with auto savings, diversified funds, and fewer surprise subscriptions. See you next episode.